Hey everybody, just making this video to help provide a walkthrough for the second midterm study guide here. And so I've got a number of problems. These are basically the same problems that we had worked on in class. And I'm going to go ahead and leave a tab blank and then copy a tab over and go through the answers so you all can kind of test yourself and check the answers if you want to just look at the Excel as well and do that. So without further ado, let's dive in. So in problem one, it's just asking us here to analyze a number of different types of accounts and understand whether we're going to, whether that account should have a debit or credit balance in the normal course of business. And so as far as whether an account should normally have a specific type of balance, remember that that is also the debit or credit is what increases that account. So let's work through some, and hopefully that'll become kind of clear as we solve some of these. So first thing I want to do though is just put in my DEAD, dead circle acronym, just to put this on our sheet here so we can refer to that as we go, and hopefully kind of reinforce how to use this little tool to help us think about what these answers should be. So remember, with our dead circle, we're saying that what side is it, a debit or a credit, that increases these different types of accounts. And so this E stands for expenses, assets, and then draws or withdrawals. And those are all increased with a debit. And then revenues, contributions, or investments into the business, or capital, you could think about it as well, so equity in general, or liabilities are all increased with a credit. So debit, credit, or that's just left and right. And whether that's an increase or decrease depends on what type of account it is. And these are the types of accounts in which one which increases these types of accounts. Again, assets increase with a debit, for example. But also that also tells us those types of accounts should normally have, if it's an asset, it should normally have a debit balance. If it's a liability, it should normally have a credit balance. Okay, so let's work through just some example problems here. So our first one, we look at, we have the account noted as vehicle. And so we do have to be able to understand what type of account a vehicle is. And remember, an asset is a thing that you own. A vehicle is something that the business would own. And so that is going to be an asset. And so we can see that that would be under the D side there. So it's a debit, normal balance, and increase. Okay, office supplies. Similarly, office supplies are things that we own. So again, that's an asset account, and it's the same thing. All assets, will be treated the same. And it's the A under the D means the debit is the increase, so it increases on that left side. Wages payable. So remember, any type of payable is something that we will need to pay in the future, and that's pretty much the definition of a liability, which is an amount that the business owes. And so anytime you see payable, that's going to be a liability. So that will have a credit normal balance. Notes receivable. So anytime you see receivable, that's going to be something that the business is going to receive. So kind of the opposite of a liability. And we own that right to receive those funds in the future. So anything with receivable on it is going to be an asset. And again, that's a debit normal balance. Rent expense, that kind of is easy when we use our dead circle. It's expense. It's under the D. So we debit there to increase. Building, again, just like vehicle, it's a long-lived, depreciable asset. We would have depreciation expense on both of these. And those are assets. It's something we own. And so we're going to have debit there. We've got withdrawals. And also, just I kind of noted equity here as an equity impact. And so withdrawals or draws, also the D here, hints us in the fact that this is a debit normal balance. Depreciation expense, again, all expenses will be treated the same, just like all assets would be treated the same. So expenses have a debit increase. Service revenue, we've got revenue right here in our dead circle, so you can kind of tell there that revenue will increase with a credit. And finally, accounts payable, like I mentioned before, anything with payable in the title indicates something that we owe, and that's pretty much the definition of a liability. And liabilities increase with credits as per dead circle there. And so I would just, practice, step one is just definitely understand, how to use this little acronym. I think that's probably the easiest way to kind of memorize what increases. And then if you know what increases an asset, for example, you also know by default what decreases it, because it's just the opposite of what it's under. So an asset decreases with a credit. A liability increases with a credit, but decreases with a debit. So make sure you know how to use that. And then familiarize yourself with different types of accounts and make sure you're able to do like we just did and identify, a vehicle is an asset, a payable is a liability, so on and so forth. Okay, let's take a look at problem 2. Just bear with me while I create our little answer sheets here. You know what, I'm just going to delete this bottom one out so we just have one to look at. Okay. So in this problem, we're just gonna, like I said, again, I'll leave this blank here. I do need to bring in or create at least a little de facto general journal, because in this problem, what we're gonna want to do is to post our journal entries related to these transactions, essentially. And so I'm just going to take over. Here we go. So we've got a little general journal here that we can post into, and let's record our transactions. Okay, so July 1st, and again, actually, step 1, I'm going to take our dead circle because that still is valuable, especially here as we're looking. Whoa, that looks weird. As we're looking at that looked weird. Let me do a little snip screenshot so I don't have to mess with the cells being a different size. Okay, so this will help us when we're doing our journal entries here. So let's say on July, so 7/1, and I'm just gonna, I don't know why that's coming up red. Here we go. Okay, July 1st, we paid $36,000 for a year of prepaid rent expense. So remember that prepaids are always assets. So we're going to increase those with a debit. And remember, our debits go first. So we're going to say prepaid rent expense. And that's $36,000. And then we're paying for this. So we're really, remember we talked about kind of exchanging one asset for another, essentially. And so we're paying for this with cash for the same amount. So cash goes down $36,000 for 12 months of rent, and this is basically us paying this at the start of the whole year. And so prepaid rent expense goes up by that amount. And we'll say pay 1 year of rent expense for our explanation. Okay. I'm just going to copy this down, and then just to have that format is nice. But in this, so let's update now and say we paid a $500 cleaning bill. So a cleaning bill is, we paid that amount. When we look at the rent expense that we're prepaying, that gives us the right to use that, stay in this office or whatever it is for a year in whatever this rent building is associated with. But the cleaning is done. We don't have any future benefit to gain from it. We're just paying for something that already happened. So that's kind of the definition of expense. So we'll say cleaning expense, and we paid it with cash for $500. And we'll just say pay cleaning bill. Again, we don't need anything too elaborate in our explanations. Just put something in there that's relatively basic. Okay, so here we provided services to a customer for $10,000, and we received cash payment that day. So receiving cash, that's an asset, right? So our assets are going to go up with our debit. and that was for $10,000. And then the definition of performing services and receiving payment, and really just performing services and being owed money, that's the definition of revenue. And so we're going to say service revenue for our credit, and here dead circle revenue, credits are increases, so that all kind of makes sense. And we'll say performed services. Okay. Okay, on the 11th, we received an advertising bill for $1,000 that will be paid later. So that's one of the key things. If you ever see it, saying we got an invoice or a bill and it's going to be paid later, that's really a key to draw your attention to the fact that we have a liability that we now have incurred, and we're going to need to pay this later. That's the definition of a payable or a liability. It's payable. So we're going to say that's accounts payable for $1,000. And we've got advertising expense to go along with that. And again, $1,000. And we'll just say receipt of advertising bill. Again, nothing fancy, needed there, basically. Nothing complex from an explanation perspective. Okay, one thing I'm going to do here, because we're scrolling off the page a little bit, is I'm going to freeze these panes. And so what that does in Excel is it just freezes the top one, so when you scroll down, it still is visible. So just that's what I'm doing, so we can still see as we go down. And I'll bring down the dead circle, so we've got that in view. Okay, so that was the 11th. On the 12th, we provided services to a customer. Now we provided services and we're going to be receiving that cash later. Here we're paying it later, so that's a payable. But when we're going to receive the cash later for services provided, that's a receivable. And a receivable is an asset. We're owed that money. So we're going to say accounts receivable. Again, an asset increase. And later we'll get the cash, and receivables will go down and cash will go up. But right now we're just recording the revenue that we earned. So again, service revenue, and we'll say 7,500 credit. It's a revenue. Revenue's under the C, so credit is an increase, and that's great. And July 12th, we'll just say provided services on account, we'll say. And when we say on account, that could either indicate that we're going to be paid later, or also if we're talking about payables or expenses, us having to pay that later. So, okay, on the 14th, we paid $6,500 to the bank to repay a bank loan. And of that amount, $450 was interest. So this one is a little more involved. Let's start by just kind of looking here to think about, we paid $6,500. So when we see paid a certain amount of cash, we can kind of start with our cash, and we're going to debit that. Cash is an asset. Remember, we're paying it, so it's going down. So it's going to be a credit of $6,500. And then it tells us that $450 was interest. And remember, when we're paying interest, that's an expense. So it's a debit. So we can say interest expense $450, and then the rest of the cash, the difference between the $450 and the $6,500, then whoops, I have to do that the other way, $6,500 and $450, so $6,050 then goes to repay the principal of the bank loan. And so what we're going to call that one is notes payable, which is typically the liability account that we use to reflect long-term debt. And we're talking about bank loans, which are long-term debts. So that's a liability, and a debit is decreasing that liability, and that is what we're reflecting here. And we'll just say paid bank loan. Oh, spelled that wrong. Okay. All right. So sometimes, journal entries can have 3 lines. It can have, as many lines as there's no specific requirement for journal entries to have any set number of debits and credits. They just all have to add up to, the debits have to equal the credits. So in this instance, these two together equal 6,500, which is the same as our credit side. Okay, so we're on to the 18th here. So we received payment from the customer. So from this transaction, we were owed the $7,500. So now our accounts receivable is going to be credited. Earlier, we debited that accounts receivable asset to increase it, but now we're going to reduce it because we want that accounts receivable balance to go away because we have now received the amount. So it's no longer a receivable that we need to reflect. And we'll say collected payment from customer. If we didn't reduce the receivable, it would appear in our records, our accounting records, that customer still owed us the money, but that's not the case. So that's why we need to reduce the receivable to 0. Okay, and then on the 29th, we paid our advertising bill here from the 11th. And so in this one, similarly to the receivable and how we need that to go to 0 to reflect that we have collected the full amount from that customer, we now need our liability to go to 0 when we do this account to reflect that we've fully paid off our bill and we no longer owe that as a payable or liability. And so to reduce a liability like a payable, remember to increase is a credit, which is what we did here. So by default on our dead circle, we can see reducing the liability then is a debit. And it also kind of stands to reason that as we're paying the cash to reduce that liability, cash is an asset, which has a debit increase and a credit decrease. And so that kind of checks out and makes sense. So cash goes down 1,000, accounts payable goes down 1,000. So the payable, which originally was credited, now is debited to go to 0. And we'll say paid advertising bill. And then our payable is now 0. And that is what we intend to happen to reflect the fact that we no longer have an outstanding liability related to that bill. So there we go. I'm going to unfreeze the panes now, and that'll reduce the break in our spreadsheet that allowed us to scroll up and down there. And yeah, let's move on to the next problem. Okay, so in problem number 3, it provides us with an unadjusted trial balance and it shows us some balances and asks us to make a number of different adjusting journal entries. So again, I'm going to, first thing I'm going to do is make a copy of this tab. Paste that in. And we'll work through the problem. So here we can see our trial balance shows us our debits and credits, and this is our unadjusted trial balance. So this is before we do our adjusting entries. And with these balances, now we're going to adjust those, or some of these, based on the journal entries we're going to make below. So let's do our first one here. Again, with red. Let me change that. Okay. So on the 31st, they're all going to be on the 31st. We typically make adjusting journal entries on the last day of a given month. And so on the first one, anyway, we accrued $320 of interest on a bank loan. And we can see we have a bank loan here, notes payable, $9,000. So we don't need that balance because it tells us what the interest is. And again, actually, I'm just going to keep taking our dead circle over because it is handy here just in case you want that as a reference. And so as we are recording interest and we're accruing this interest, and when we say we're accruing interest, we're not paying it, but we are recognizing that expense and recording a payable to indicate that we now owe that amount of interest to the bank at this time, essentially. So we're going to use a special payable account called interest payable, not accounts payable. Accounts payable is typically used more for vendors that we work with, etc. Interest usually has its own type of payable account because it is so different. And then we're going to record an expense that associates with that interest. And remember, expenses are debits to increase, payables are liabilities, increase with the credit. And we'll say accrued bank loan interest. Okay. Okay, the second one says the balance of the prepaid insurance represents 8 months, including May, and we're in May, the month of May. And the insurance for May expense has not been recorded. So let's come up real quick and just highlight. So here's our prepaid insurance. We bring that balance out. We said it represents 8 months, including the current month that we're looking at. And so if we take that balance of prepaid insurance, divide it by 8 months, that tells us that it's $200 per month of interest expense that's basically represented by the $1,600. We're at the end of May, and so one of those months has been now used up. And so for our adjusting entry, then we're going to record insurance expense for $200. And we're going to reduce our prepaid insurance asset, which, until this point of recording this entry represented 8 months. But since we have already used up one of these months, which was May, we need to bring that down by 200. And so after we do our journal entry, this balance of 1,600 would now be 1,400, which would represent 700 months. And you can still see same amount per month, but it's now lower by 200 after we book this entry for reducing our asset with a credit of the $200. And we'll just say record monthly rent expense. Okay. Now we've got an indication here that we have completed $1,000 of work that was previously unearned. So here's our unearned revenue. Remember, that's a liability. And now we've, this 4,000 of prepayment from customers that we received for future services, $1,000 of those payments has now been provided. That service has been provided. And so we need to reduce our unearned revenue liability by the $1,000 that's no longer a liability, basically. And so we're going to have 1,000, and we're going to debit our unearned revenue. Remember, it's a liability. And so debiting that liability will decrease it. And then it changes from a liability, that portion, to revenue. So now it's cash. We already got the cash, but it was a liability up until this point, at which we have now recorded a portion of that initial $4,000 in as revenue. And we'll say record earned revenue. So over time, the unearned revenue becomes earned, essentially, and in saying that, it becomes service revenue. Okay, we have 1 month of depreciation. That's $700. And so remember, with depreciation expense, we have some special accounts that we use, or at least, there are, I guess we can say they're both kind of special accounts. We always use depreciation expense. And we'll say record depreciation expense. And so we use depreciation expense. Expenses are debits to increase, so that makes sense that we are debiting it. And then accumulated depreciation is a contra asset account, kind of a special account. And it's not like exactly represented here in the dead circle acronym, but think about, if you just remember that contra assets, they're basically opposite of assets. So they have the same characteristics, for example, as a liability. So with the contra asset, like accumulated depreciation, it increases with the credit and decreases with debits. And so we're increasing that accumulated depreciation by $700 and recording the expense. And then remember, on our balance sheet, this amount is an offset to the historical cost of an asset to bring it down to what we call net book value, which would be the current cost minus all that accumulated depreciation that we booked throughout the whole life cycle. And we'll look at that in a little bit of detail in a further problem here in a moment. Okay, and then the last adjusting entry, we provided some services that are going to be paid for later. So this is kind of the opposite of an unearned revenue where we got the cash but hadn't yet earned it. This is us providing services but not yet getting the cash. So it is service revenue now because we already earned it. But again, remember, if we have amounts that we earned that we haven't yet received, we're going to receive those. That's going to be reflected with an accounts receivable asset increase. And we'll say record receivable for services provided. Again, that's just kind of nothing special about the explanation there, but just, putting our explanations in. Okay, so that's great. We've got those all recorded. And let's move on to problem 4. Okay, we're now on to problem 4. So let's make a copy, move it to a different tab. Oh, I'm going to go back through. So again, like I said, I'm going to leave a blank tab, but I'm going to take this and paste it in here for you all to if you want to give your, work on this yourself and do it yourself. That'd be great. But you have the answers to check against, so that's good. But let me just put these journals in here blank for you to use if you'd like. Oh, and that's going to be problem 3. Okay, problem 4, and then problem 4 answers. And we can just do the answers directly into our tab here. And so in this problem, we say on January 1st, we have this business that purchased the truck for $50,000. We've got a useful life of 6 years with no residual value. And we're going to input the depreciation expense, accumulated depreciation, and net book value over the life of this asset. And so maybe the first thing I want to highlight is how the formula for depreciation, essentially. So it's the cost minus the salvage value or residual value. In this it means the same thing. We'll use residual value because the problem does as well. Okay, so cost, maybe I'll put here less, so indicating it's minus residual value, and that equals, and then we divide by, and we'll just say, maybe I'll do this here, divided by, I'm just going to put a little space there between these, so divided by the life, and that can be in years or months. And then this will give us our depreciation expense for those, either month or year. So for example. So let's just kind of use this, or I don't want to do this. I'll just do it off to the side here. So in our instance, we have the cost of this vehicle as $50,000. Just do some formatting. So $50,000. We have no residual value, so we're going to put 0 in there. If it said we had, 500, we would put, 500 there and subtract that from 50,000, but it says 0, so we're going with that. And in this instance, we're just going to do years, because we bought the truck on January 1. So we only need to know full years of depreciation. So if we divide by that, we get 8,333 per year. And then similar, just to highlight here, if we wanted to know that by month, we could multiply the years by 12. So 6 years is 72, sorry. 6 years is 72 months. Just multiply by the years by 12 months. So that's the same thing. So $694 per month. If we were to multiply that by 12, it would get us the same as the annual, 12 months. And then just to highlight, here how this could play out if we did have a residual value. If we said we expect to have a $10,000 residual value, then our calculation would say the original cost minus the original cost minus the residual value divided by the life. And so you can see our depreciation expense would be decreased because over these 6 years we would be only depreciating. We would only take 40,000 of total accumulated depreciation over the life of the vehicle, because we would still want it to have a total ending net book value after the 6 years of $10,000. So our total accumulated depreciation would be 40,000. So you would take 50,000 cost minus 40,000 of depreciation, accumulated depreciation over those 6 years would equal 40,000 of accumulated depreciation. So, like, for example, this is what, 1, 2, 3, 4, 5, 6. So if we did this, 6 years, and then we added all those together, which is kind of what we'll do here in a moment, gets us $40,000. That would be our total accumulated depreciation after 6 years. And then if we want, then our cost minus this total accumulated depreciation, 50,000 minus 40,000, would leave us a residual value of 10,000, and we just wouldn't do any more depreciation. But since we're doing no residual value, so I just copied this over here, you can see we've got 88,333. So 6 years of that leaves us with a total accumulated depreciation, which equals the cost because there's no residual value. So 50,000 minus 50,000 is 0. And so after the full year or full 6 years, we'll have 0 residual value showing on our balance sheet. Okay, so those are kind of similar to what we're going to do over here, but let's just do this again. So the cost never changes, so that's going to be the same throughout the whole life. That stays the same. The cost is just the cost. And we don't sum up the cost because it's not an addition every year. This is just the same cost we historically paid for it over the whole life. And then we have, again, that depreciation expense of per 6 years. And we're doing years because it's the full year. So we bought it on January 1st. So we're going to get a whole year out of there. And we can just drag that down. This is the same thing basically we were represented here. And then we sum those up, again, kind of similar to what we were representing there. It totals up to 50,000, which is what we were just talking about. And then the way that the accumulated depreciation works is that every year we add in the current year's amount of depreciation. And so this thing just grows over time until it gets to the total of $50,000. And we don't add those up either because this is just a balance at the point in time. It's not it doesn't keep getting added to once this thing is fully depreciated. And you wouldn't like sum these together for any reason. You would sum these together to get a total over the life, but that would also be reflected in the additive accumulation in the accumulated depreciation account. Okay. And then for our net book value, this is kind of what we were talking about here with the ending residual values. We just take the cost minus the accumulated depreciation, and that gets us our net book value over the life of the asset. And as you can see, it's going down by the amount of depreciation each year as the accumulated depreciation increases. And when we get to the end of the whole life cycle, that's when we end up with a 0 net book value. So alternatively, if we had done a $10,000 residual value, this value at the end of the life would be 10,000, not 0. Again, because we would end up with 40,000 of depreciation, not the 50,000 that we have here. But this one says 0 residual value, so that's what we go with. And really the only one where it makes sense to add all of them up is depreciation expense. You wouldn't really add these. You wouldn't add, these are all as of a point in time. And these are expenses that you would add together. So having a total column here is kind of funny. It doesn't make a whole lot of sense except for depreciation expense. Okay, let's move on to problem number 5. And I might need to grab a trial balance here. We need, this one is asking for the preparation of financial statements. So I've got a few copies here. Bear with me while I bring these over. Okay. So here we can see we've got a trial balance, adjusted trial balance. We're done with all of our work, and we've done, any adjustments we would have. And so we are going to now prepare our set of financial statements using that information. And so the way we want to put our titles in, we'd have the name of the business. We're going to start with the income statement, and this will be for the year ending October 31st, 2022, this one says. It tells us it's for the year ending right there. It could be for the month if we were just looking at 1 month, but this tells us for the year. Let's do our titles here for all of these. So then we've got the same, we bring our title down to each one of the statements. This will be our statement of owner's equity. And this will be our balance sheet. And we'll be preparing these top to bottom, income statement first, owner's equity, and then balance sheet. And we'll have the same for the year ended designation on the statement of owner's equity. But the balance sheet, we're going to say as at October 31st, 2022. So that's kind of key to remember, kind of important, is that the balance sheet is as of a point in time, at October 31st at the very last minute, basically, or, the close of business. If we were to look in our checking account, for example, for cash, we would see $10,000. But the income statement is going to reflect how we got from, last October's balance to this October's. It's over that whole year, essentially. How much have we earned? How much have we spent on, had it for expenses, etc. So distinction there. Okay. So when we're going through then, we're going to fill out our income statement. We're going to say service revenue. And I can just link in here to Excel. So we've got 15,000. And remember that these are not debits and credits. There's no debits or credit columns on the financial statements. That's just in our accounting records and the trial balance, etc. Here, we're just inputting the balances as pluses or minus, essentially. So we've got revenues and expenses, and that's the primary things that we put onto an income statement. So I can just link these, which is nice in Excel. Unfortunately, you guys can't do that on the exam, and you'll have to, draw some of these out, write some of these out. So I apologize for having to do that, but that's just kind of the way it works on the exams. Okay, so then we have total expenses. So these are all the expenses, and then we just sum them up like so. And then with this information, we can calculate net income here. So we take our revenues minus our expenses, gives us 8,250 in our example for all of the totals. Okay, and that's the primary thing on the income statement, revenues minus expenses, and then we get net income. And then we're going to take that net income and put it onto our statement of owner's equity. So here on our owner's equity statement, we're going to start with capital for that specific owner. That's their equity account. And here we can put, I'm going to not just link this, but paste it in as a value and say at October 31st, 2021. So this would be like our, or I guess I could say at November 1st, if I want to say beginning balance of this year. Either one you could really use, because October 31st last year would be the beginning balance, or November 1st is kind of the starting balance as well. But that number will be the 8750 we see here is the starting balance, and everything else that's going to go into equity that's been recorded this year is all this stuff, and we're going to end up with ending equity. It is basically what the closing process is that we'll look at. But let's fill it out in our form. So typically, we would list out additional investments if there are any. Those would have to be identified separately in the problem, because the investments during the year would just be included in this balance. So if we did have investments, you would need to take those out of the 8750. For example, if it said $2,000 was invested into the business during the year, we would note the 2,000, but then we would need to reduce this amount by the 2,000 so that the ending combination of these two things equals what's shown in the capital account. But this one says 0 investment, so we don't have anything there for this specific year. Maybe in a future year there might be some. Net income, or we would subtract a loss if there was, so we can just bring this down. And really, since that's the only thing we have, I'm just going to put that here in this column. If we had investments and net income, we could sum those up with the subtotal and bring them over, but that's not the case. Okay, let's say and then less our withdrawals. And in this instance, we have $2,000 in withdrawals. And then I'm just going to link up to this to pull that same information down, basically. Copy and paste values. That's what I'm doing there, which removes the link and allows me to come in and edit what we're saying here. And I'm going to say October 31st, 2022. So that's our ending balance or I have to do it here. The beginning balance plus our net income minus our draws ends up with 15,000 in equity. Okay, and then on our balance sheet, our equity is going to come down to our balance sheet. That's why we do it in this procession, starting with income statement. This first, this second, this third, because we have to net income first. That comes here, then calculate capital and ending equity, and then that comes down to the balance sheet. Okay, so on our asset, we're going to have assets, liabilities, and equity at a point in time here on our balance sheet. And our assets are all up here. We have cash, AR. I think that's all of them there. And we'll just link all these in. Okay, that'll be total assets. Remember that if we had accumulated depreciation, which we don't in this example, that would go with the assets, but it would be a reduction to the equipment balance. That's that net book value that we were looking at. Then we are going to sum all the assets together. So we have 27,600. And we'll say liabilities. And in this instance, we have a variety. And we're trying to get into capital, so we don't want that. Okay, let's input our accounts payable. Again, there's no debits or credits. These are just balances that we're pulling in, even though they are pulled in from these represent behind these numbers. If you look in the accounting records, this would be a credit normal balance. This would be a debit normal balance. But on our income statement reports or our financial reports, we just financial statements, to say it properly, we just list those out as totals. Okay, so our total liabilities then is 12,000 liabilities. I want that formatting to match there. So that's that. And then we have our equity section finally. And we'll just say owners, equity. And we'll just pull this in. 15,000. I'm going to take off the underline there. And then the final thing we do is say liabilities and owner's equity. Remember, our accounting equation is assets equal liabilities plus owner's equity. So when we add those two together, we want to make sure that the assets equal liabilities plus owner's equity. And they do. So we are in luck. We put our things all in together accurately, and we are complete with our problem. Oh shoot, that was my answers. That's okay. I'll just paste this in and change the title. And then I'll just clear these out if you all want to give it a shot yourself and make sure you understand how to solve the problem. If you can solve these problems without my assistance, or do it once, with the video, and then go back and do it without it, you're going to do excellent on the exam. Okay. All right, let's get into the last problem here. And so the last problem that we look at gives us an adjusted trial balance. And we just need to go in here and do our journal entries, our closing entries, for one thing. And then we also need to prepare a post-close trial balance. So we'll just kind of put these all in here. We'll link over to that amount there. And yeah, let's take a look. And so one thing to remember with our closing entries is the REID. And if you remember, that stands for revenues. We're going to close revenues first, then we're going to close expenses. We're going to close both those to the income summary, and then we're going to close the income summary next to capital. And then finally, we close draws, withdrawals, same thing basically. The D really represents draws, but we're going to close draws to capital with the final step. So with that said, let's take a look here. And so we're doing this all again at the end of the accounting period that we're looking at. So September 30 in this instance. Looks funny. I kind of want to have that show a little differently. Okay. Whatever. I'm not too worried about it. Let's just leave that in that date format. That's fine. Okay. So remember, we're closing revenue first. And so recall that with our closing entries, we're always doing the opposite. It's like opposite day, right? So we just, if it's a credit balance, which it should be for revenue, remember our credit normal balance, then we're going to debit service revenue. And remember that we're closing the temporary accounts only, which are all of these things, draws, revenues, expenses, and all of these permanent accounts, capital, liabilities, everything that's on the balance sheet. Those are all permanent. They stay. They go to the next month. But all the temporary accounts only apply to the month that we incurred them in, and they get closed into capital. And they specifically go to zero so that we can start filling them back up in the following period. So every month, this is September, has its own amount of revenues, essentially. So that's the whole idea there with the closing entries. And remember, we're closing everything to the income summary. So we start with revenue. It's opposite. So we just do the debit because it had a credit normal balance. And we'll just say close revenue. Okay, and I'm going to take this here, but expenses are going to look a little different. We're going to start with the income summary because remember that we have debit normal balances for expenses. So to close these accounts to zero, we want to credit those. Again, it's the opposite. And the way I'm going to do that is just to link to the titles for the accounts so we don't have to type those in. Telephone. Okay, that was everything. So these are all the expenses here. They're all debits, remember, so we're going to credit those. So reduce them to zero now. And And then we're going to debit our income summary for that total. So 5650, which would be our total expenses. Those are now closed, all closed into income summary. Okay, so that was our E. Now we're on to the closing the income summary to capital. And so to close the income summary, what I like to do is just to look at the debits and credits on the income summary between these two entries and see what side we need to debit or credit to get them to balance. So we can see we have $15,000 credit and a $56.50 debit. So we need to add to the debit side to get it to equal to the larger one. If it was opposite there and revenue was, we closed revenue was $56.50 and the expenses all added up to $15,000, then we would need a credit to get it to close. So we're really just finding which side needs an increase to get it to balance. And in this instance, that's a debit. So we're going to debit our income summary, and we're going to debit it for the difference between these two. So 93.50. So here, if we took 56.50 plus 93.50, we get 15,000. And now we're balanced on our debits and credits. And that indicates then that the income summary itself is now closed. And we close that into capital. And since we're crediting capital, we're going to indent it. And we're going to credit it by the amount of the closing entry for income summary. And now we're done with the income summary is closed out. All these revenues and expenses have been closed into capital, essentially, kind of the net impact of those, which is also net income. Remember, that's what we're doing, basically the difference between revenues and expenses gets closed into capital. And remember back, if you look at our problem here, that's what we're essentially doing on the owner's equity statement, because we're taking beginning capital and changing it by net income, which is revenues minus expenses, and draws to give us an ending balance. And we're doing the same thing just with the actual accounting here. So again, the final step in terms of the entries is to close draws. And so again, it's just opposite. So we're going to credit draws because it's a debit normal balance, but we want to do our debits first. So we're going to, not income summary. We're going to, that's there, but we want to debit capital now. And we can then just to start with our draws and do our opposite day kind of thing. So it's a debit, so we're going to credit that for 3,000. Again, just the opposite. And capital is then going to be credited for 3,000, which reduces capital because a reduction to capital is a debit, and where the draws reduce capital. Okay. So that's all of our journal entries. Oh, I forgot to put, let me just add this to be proper. So we'll say to close expenses. We'll say to close income summary. And to close withdrawals. Okay, so that's everything there. And that's all of our closing entries. And then the last thing we just need to do is prepare our post-close trial balance. And so it's pretty easy because, let me change the font there. The only permanent account that has been changed is capital. So I'm just going to drag these down. These are all our permanent accounts that go on our balance sheet. These will all be the same. Nothing's changed, in the permanent accounts other than capital. Okay, so again, this is just a direct copy up to this point, but then capital is going to be changed, and let's do this like this. So here's our starting point. It's a credit beginning balance, and then let's just kind of go over to our closing entry and adjust it for these journal entries. So we started with our credit. Now here it's being credited, so that's going to add to that credit balance. And so we're going to, start there, plus 93.50, credit plus credit, and then we're going to debit for the draws, which is going to reduce our credit balance. And we're going to say, so So beginning credit plus an additional credit for the net income minus a debit for the draws gives us 22,400 ending balance. And then we can, I'm just going to copy this over, gets our totals, fix our formula. We can already see that it works. And we end up with 38,500 on debits and credits. And we are all closed. So then we carry these balances on to the next month. So what would that be? September, October. So October 1st, these are our beginning balance of our permanent accounts. And then all of our temporary accounts are 0 over here. And we begin, putting amounts into those in October. And then we do the same process of closing at the end of October again. And all of that activity in October and every month gets closed into the equity account, so capital here. So, all right, cool. Well, that brings us to the last problem. I'm going to make this. Oops, sorry, my video cut off right as I was wrapping up. But I was just saying that, yeah, I'm going to have this as the answers tab, and then I'm going to delete out all the rest of this. And then if you all want to practice, you've got a blank space to practice, and you can check your answers against what I got. All right, great. Well, I'll save this to Canvas, the template. I will save a link to the video so you can watch and follow along. And I wish you the best of luck on the exam and good luck studying. And let me know if you have any questions. All right, thanks, everybody.